We at Wealth and Millennial want to help inspire, educate, and motivate you to make the best financial decisions possible. With our straightforward, no bullshit approach, we aim to simplify the complex world of personal finance for the millennial mind. We Canadians are known for paying a fair amount in taxes. Income tax, property tax, taxes on goods and services, and even on our investments. That's right, all investments are made post-income tax and then taxed again when you draw the money later. So how the hell do you get around this? Thankfully, the Canadian government has been kind enough to offer us two tax-sheltered investment options, a registered retirement savings plan and a tax-free savings account, both offering the investor the opportunity to grow their wealth while only having to pay tax on their money once. But which of these accounts should you put your money into? How will they affect your investments when it comes time to withdraw? And which will leave you with the most amount of money at the end of the day? Stay tuned to learn the answers to these and many other questions relating to your RRSP and tax-free savings account. What are they? Let's break it down. RRSP stands for Registered Retirement Savings Plan, and TFSA stands for Tax-Free Savings Account. Both offer tax advantages that can help you achieve your savings goals sooner. Let's compare the two. RRSPs. Must earn an income to contribute. Contributions are tax deductible. Cannot withdraw without paying tax. Age limit for making contributions. Intended for retirement. At age 71, you must close your RRSP and move the funds to an RRIF, Registered Retirement Investment Fund, or an annuity. With RRSPs, you deduct your contributions from the income you report on your tax return. Tax-free savings account. You do not need to earn an income to contribute. Contributions are not tax deductible. Tax-free withdrawals. No age limits for making contributions. Can be used for any type of savings goal. There is no age limit set for investing in this account. And with a tax-free savings account, you don't pay any tax when you withdraw the money. Which one should you invest in? This is a difficult question to answer and really depends on your tax rate during your working years compared to when you retire. If you're taxed higher during your working years, you'll want to defer your taxes to when you withdraw, making an RRSP the better option. On the flip side, if you're paying less in taxes now than when you retire, a tax-free savings account is a better bet. The reality is, you will end up paying taxes either way, so the question really becomes whether it's beneficial to pay them now or later. Things to consider. Although your rate of taxation is the main consideration when choosing which account to contribute to, there are still a couple other factors to mull over. Here are a few. Taxman. As mentioned above, you need to consider how much money you're currently paying in taxes compared to how much money you'll be paying once you retire. Knowing these figures will play a big role in deciding where your savings go. Change of plans. Be sure to think about the money you're saving. There is a difference between saving and not spending. Saving is the act of building wealth, whereas not spending is just holding on to money until you need a new car or are forced to splurge on an emergency expense. If you are saving your money for retirement, both accounts can be considered. If you're simply saving with the possibility of using this money to purchase something in the future, then the TFSA is for you, since you're able to withdraw at any time with no penalties. You also want to consider the money moves you'll want to make in the future, as well as the present. If a few years down the line, you'd like to purchase an investment property, instead of investing solely in the stock market, having your money in a tax-free savings account gives you the option to withdraw the money to make the purchase. Understanding what you're saving this money for will be the deciding factor as to which account you use. Clawbacks. Another factor to consider when deciding whether to fund your TFSA or RRSP are potential clawbacks on senior benefits like old age security and guaranteed income supplement. RRSP and RRIF withdrawals count as income, thus giving the CRA the impression that you do not need as much government assistance in retirement. Employer contributions. If you work for a company that matches your RRSP contribution in a workplace retirement plan, Be sure to max this out, even if they only match at 2%, 3%, or 4%. Any additional income from your employer is like getting a small raise and should be considered in your total compensation. Sure, you won't feel the effects of it until you retire, but it's essentially free money. Tax examples. With your tax-free savings account, your contributions aren't tax deductible, meaning you will have to pay your tax on the initial investment. The benefit comes down the line when you're able to withdraw without paying any taxes. Your RSPs, on the other hand, are tax deductible, meaning you'll be returned the tax you paid on any contributions. The downside is that you have to pay the tax when you begin withdrawing your money after retirement. Let's compare identical scenarios for both your tax-free savings account and RSP to see how they compare to one another. TFSA. For argument's sake, let's say you can afford to invest $5,000 a year from your net income. Regardless of which account you invest that money in, you've already paid income tax on it. If your rate of taxation is 32%, that equals out to $1,600 in taxes. Now, if you invest $5,000 a year for 30 years in your TFSA and have an average annual return of 5%, your account will be worth $348,000. This means $150,000 of that money is what you put in over the 30 years, with the additional $198,000 being the interest you earned. Since you don't pay tax when you withdraw from your TFSA, all that money is yours to keep, every last penny. With that said, you've technically been paying income tax on your initial investments, which we calculated to be $1,600 a year. So over the course of 30 years, you've paid a total of $48,000 in taxes. If we take the exact same situation as mentioned above and apply it to your RRSPs, the end result looks a little different. Since the contributions are tax deductible with this account, at tax time you will be refunded the $1,600 you paid in taxes on your investments. To keep the two scenarios equal, you would have to reinvest that $1,600 into your RRSPs, turning your annual contribution into $6,600. This new amount of $6,600 for 30 years with 5% annual interest equals $460,000. Seems pretty good, right? At first glance, it would appear that you'd end up with a little over $110,000 more had you gone the RRSP route. Remember, you still have to pay taxes on the money, so let's run those numbers to see how everything turns out. Let's be modest and say you're being taxed at only 20% in your retirement. If that were the case, your $460,000 just turned into $368,000. When comparing these two situations, it looks as though the RSPs have outperformed your TFSA by about $20,000. But there are a few things that should be considered before coming to that conclusion. First of all, my assumption that you'll be paying 20% in taxes after retirement is exactly that, an assumption. I have no idea how high or low the taxation rates are for retirees. Secondly, who knows how much you'll be paying in taxes when you eventually reach retirement. Canada is bound to go through a whole lot of change in 30 to 40 years, and taxation rates are almost guaranteed to increase or drop over time. With that said, you might end up paying more in tax tomorrow than you would today. Both RRSPs and TFSAs have their benefits and disadvantages. Knowing as much information as you can is key to making the best decision for your personal situation. As always, you can head on over to wealthmillennial.net/blog to read the full article with all the links and resources mentioned. If you enjoyed this episode, please share the love. Feel free to like, comment, subscribe, and share with your friends and family. You can also find us on Instagram and Facebook at Wealth and Millennial. The more millennials we can help when it comes to personal finance, the better off we'll all be.
This has been an Evoke Media podcast.